In September 2008, grown men in suits stood in the lobby of Lehman Brothers holding cardboard boxes. The fifth largest investment bank in America had just collapsed. Not because it ran out of money, because everyone stopped believing it had any. That's the thing about markets. They don't break when the numbers are bad. They break when people stop trusting the numbers. Here's why this matters right now. We're living through the most interesting trust experiment in financial history. Central banks printed trillions. Governments promised stability. Cryptocurrencies promised freedom from both, and somewhere in the middle, regular people are trying to figure out what's actually real. Let me show you how this machine works. Every market runs on a simple deal. You give me your money today, I promise to give you more money tomorrow. That promise only works if you believe I'll keep it. The moment you don't, you want your money back, right now, not tomorrow. And if everyone wants their money back at the same time, the promise breaks. We call that a bank run. But here's where it gets strange. In modern finance, your money isn't sitting in a vault. It's been lent to someone else, who lent it to someone else, who used it as collateral to borrow even more. Your $100 might be supporting $1,000 of bets across the system. This works beautifully when everyone stays calm. It implodes when they don't. Silicon Valley Bank understood this in March 2023. They had plenty of assets, bonds, safe investments, but when depositors got nervous and started withdrawing, SVB had to sell those bonds at a loss to get cash quickly, a $16 billion loss. The bank didn't fail because it was broke. It failed because it couldn't prove it wasn't broke fast enough. And that's the uncomfortable math. Speed now matters more than solvency. Think about what happened next. Within 48 hours, $142 billion fled SVB. That's not a bank run, that's a bank sprint, enabled by smartphones and group chats and the fact that panic spreads faster than explanations. Now zoom out. This isn't just about banks. Credit markets run on the same trust, so do currencies. Even the dollar, backed by nothing but the full faith and credit of the US government, which is a fancy way of saying it works because everyone believes it works. For decades, that belief held. Then 2008 happened, then the pandemic, then inflation, then rate hikes. Each crisis required the system to ask people to trust a little harder, to believe a little more. At some point, belief gets expensive. You can see the cracks forming. Bond markets are pricing in recession, while stock markets hit new highs. That doesn't make sense unless different groups of investors believe completely different things about the same economy. Crypto tried to solve this with code instead of trust. Be your own bank. Trust the math, not the institution. Then FTX collapsed because turns out the institution running the math was lying. Sam Bankman-Fried went to prison. The irony wrote itself. So where does that leave us? We've built the most sophisticated financial system in human history. We've engineered away dozens of risks, created safety nets and circuit breakers and backup plans, but we still can't engineer away doubt. And here's the thing nobody wants to say out loud. The next crisis won't announce itself. It'll just be a Wednesday morning when everyone suddenly decides to check if their money is actually there, and the system will have about 48 hours to prove that it is. The question isn't whether markets can survive bad news. They always have. The question is whether they can survive everyone asking for proof at the same time. So far, the answer has been no.